The interesting thing that sets workforce housing, these Class B, C apartments, apart in Los Angeles compared to really any other market in the US, and we're pretty well qualified to opine on this because about half of the deals that we've done, 800 million over 30 years, were outside of Southern California. What's unique about the Class BC assets in Southern California is how they behave in an economic downturn. And I think that that's a relevant discussion for where we are today in late 2022 with rising interest rates and a war going on and 40-year high inflation and a lot of pressures on the economy. And I would say the consensus is that at some point in the next 12 months, we will be going through a recession. So how do these Class BC assets in Los Angeles perform in a downturn? In LA, the Class BC apartment sector, that is the workforce housing. The workforce can't afford to buy a home. They have become a permanent renter class. And the place that they live is in these older, smaller Class BC assets. So what happens to these assets during a downturn? What our experience has been, and the data shows it out as well, occupancy remains stable or actually increases as people move out of the Class A brand new product into the Class BC assets seeking affordability, because the rents in Class BC assets in Los Angeles tend to be about half of what the Class A market rents are during a normal economy. And so our buildings remain full, if not increase in occupancy. Rents will dip. Nobody's bigger than the market, but they rebound very quickly. What we found in the last two major downturns, COVID and the global financial crisis, is rents dropped by about 10% in the BC space in both of those cycles. Within a year of COVID, rents came back by overshot, a hockey stick, by 15%. So resumed a long-term trend line of 4 to 5% rent growth. Similar dynamic took 2 years right after the global financial crisis, but rents came back to pre-crisis levels within 2 years. They were exceeding pre-crisis levels. And so, in short, in Los Angeles, there is a cycle resiliency to demand for this workforce housing, these Class B, C apartment buildings, that is unparalleled in other US markets. And we've been active in every market from Phoenix to Atlanta. And there's really three factors. One is this is the world's largest and most dynamic economy, one of the world's, certainly one of the largest in the United States. A 50-year chronic shortage of affordable housing that's created a huge permanent renter class that can't go anywhere else. We are the value proposition. We are the workforce housing for this renter by necessity. They tend to be a lot of blue-collar workers, construction workers, teachers, firefighters, public service folks, retail service providers, folks who work in stores and retail outlets. They are the lifeblood of our service economy. They tend to be two-income households. They tend to be families. And they are completely boxed out of a home ownership proposition here in Los Angeles. So they're attracted to LA because of the size and the dynamism of this economy. But this is one of the least affordable places to live. And unless you are willing to suffer a 2-hour commute to be in Lancaster or Palmdale or the outskirts of Los Angeles, that's really the only place where there's a value proposition of owning a home that makes sense, but it's at a huge cost personally and to families. And so where most people want to reside, particularly if they're families, is as close to where the jobs are as possible, infill. And the only infill opportunity for housing for this workforce are Class B, C apartments that we focus on. We do credit checks and reference checks and employment history checks and so forth on all of our tenants. So we do the standard profiling that you do whenever you're managing a property professionally. I think that we would just find that most of our tenants' incomes fall squarely within that workforce housing bandwidth for our submarkets.